Hello, everyone. I'm Miles. After more than 30 episodes on investment banking and private equity, it's time to level up. Less theory, more real world practice. The real mindset for interviews and exams. Most people think so. M&A is about strategy. Professionals know that. But M&A is even more about price. Today, we'll look at just one deal and change only one number. Let the three financial statements speak for themselves. In finance, deeper understanding comes from calculation, not the other way around. The same target asset, $1,200 in assets, $900 in liabilities, and a tax rate of 20%. Scenario 1, you pay $200. Scenario 2, you pay $350. In Scenario 1, it's a bargain acquisition, a profitable M&A. The identifiable net assets are $1,200 minus $900, which equals $300. You pay $200, which means a gain of $100 from a bargain purchase. On the income statement, this adds $100 to pre-tax profit and $80 to net profit after tax. On the cash flow statement, since this gain doesn't involve cash, it needs to be deducted. Operating cash flow, CFO, equals 80 minus 100, which is negative 20. Investing cash flow, CFI, is negative 200, which is the cash you paid. So the total change in cash is negative 220. Looking at the balance sheet, cash decreases by 220, and the acquired assets of 1,200 are consolidated, so total assets increase by 1,200 minus 220, which equals 980. Total liabilities increase by 900, net profit adds 80, so retained earnings go up by 80, and shareholders' equity increases by 80. That's right, it's perfectly balanced. Scenario 2, acquiring at a high price and generating goodwill. The net assets are the same, but this time you pay $350. Please note, here we're talking about corporate mergers and acquisitions. On the first day, you didn't lose any money. You just became wealthier. Under GAAP standards, the extra $50 you paid in the acquisition is recorded as goodwill, not as a capital loss. What about the income statement? There's neither a gain nor a loss. Net profit remains unchanged. The cash flow statement's operating activities, CFO, are unaffected. In investing cash flow, CFI, you pay out $350 because you spent $350 in cash. On the balance sheet, cash decreases by $350, and the consolidation of the acquired assets leads to an increase of $1,200. Plus the $50 in goodwill, so total assets sum up to $1,200 plus $50 minus $350, which equals $900. Liabilities increase by $900, equity remains unchanged, and once again, the balance sheet is still balanced. Of course, in the future, if management determines that the value of goodwill has declined, it will need to be impaired. It's only at that future moment that this loss will finally be reflected on the income statement.